So, hi everyone, we are going to start a series on stock market basics, and today we are going to cover candlestick patterns. So, basically, candlesticks were first invented. I would say invented because Japanese people realized that there were certain patterns in the prices of rice. So, they used to trade rice almost around 300 years ago. So something around 1700s, they realized that there is some pattern when they were trading rice and tried to plot them in the form of candlesticks. So what are candlesticks? So basically candlesticks are these kind of figures which you might have seen in the stock market, and these are usually colored. So usually these candlesticks are of a red color or of green color. So let's try to understand the two basic types of candlesticks. So first one is a green colored candlestick, and second type of candlestick that you would see in the market is a red colored candlestick. So in both these candlesticks, two things are common. The upper part is the high and the lowest part is the low. So these are the highs and lows of the candles. However, there is a difference in open and close price. So lower is the open in case of green candle, and upper part is the close. Upper body is upper part, and in case of red candlestick, the body's upper part is open and the lower part is closed. So what I'm referring to as body is this part. This part is called body of the candle. Whereas this line like shape is usually called the shadow or tail. Similarly, the upper line like part is called shadow or tail in both the cases. So let us try to understand how each of these candlesticks are formed. So candlesticks are formed in a certain time period. So let's say if I'm looking at 1 minute chart, that means at every 1 minute one candlestick is formed, like this, or like this. So market will continue to form a new candlestick every 1 minute. So when is a green candlestick formed? A green candlestick is formed when market is going up. When market moves from one price to another price in upward direction, that is, the price is increasing, in that case a bullish candlestick or a green candlestick is formed. We call this as bullish candlestick. And this red candlestick is bearish candlestick. So bearish candlestick is formed when the market is going down. So the name bullish is derived from bull. So bull hits you like it is throwing you from down to up, and that is the reason why when it goes upside it is called bullish candlestick. Whereas a bear tries to hit you down on the floor, and that is the reason why when the market is going down, when it is going down, so it is called a bearish candlestick. So let us try to understand how a bullish and a bearish candlestick is formed. For example, if a market is going down, so let's say I have a price level of 300 and next price level is 400. Let me mark it. So let's say candlestick started to form at 320 and price moved up, then went down, touched the 300 level, and then again started to move up, touched the 400 level, and then at almost at 1 minute it closed at this price. So let's say at 00 second and at 60 second or 1 minute the price was at this level. So let's say this is 380. So the price from, so at whatever price it opened and whatever price it closed, the area between it is usually colored. So it is colored on the basis whether it is going up or it is going down. Since in this case it is going up, it moved from 320 to 380 in this period. So this becomes a green candlestick or a bullish candlestick. And the body of the candlestick is colored as green. And in this period it touches the low, it touches the high, and then closes somewhere in between. So in case candlestick closes close to high, let's say the candlestick closes somewhere here, let's say it closed at 390, then the body will be something like this. Body will be longer. If it closed at 350 only while touching 400, then the body will be somewhat smaller. Similarly, the candlesticks would continue to form. Let's try to understand the bearish candlestick. In this case, let's say market was at price level of 320. At this price the candle started to form. It went down, went up, touched the 400 level, and then went down, touched the 300 level, and then closed somewhere around 320. So it opened at 380, it closed at 320. This was the lowest point that it touched, and this was the high, that's the highest point it touched. And the body in between will be colored, and because it went from 320 to it went from 380 to 320, we will call it as a bearish candlestick or the red candlestick. So in this way candlesticks are formed. Let's try to understand this. So here I have opened trading view, and as you can see, let's try to draw the levels on a red candle. So let's take any red candle here. As you can see, for this red candle, this would be the opening price, this would be high, this would be low, and this is the close for this candle. Similarly, if I look at any green candle, let's say I take this green candle, so this would be high, this would be close because market moved up, this would be low, and this would be open. And in this way we read candlesticks. That's all for this session. Thank you.